Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. Global yields declined during the month of April 2025. 10-year German Bund, 10-year Japan bonds and 10-year US Treasury fell by 29 basis points, 18 basis points and 4 basis points respectively. Since the beginning of calendar year 2025, business optimism and consumer sentiment has dropped sharply amidst escalating trade tensions, deteriorating global growth outlook, and looming inflationary fears. U.S. consumer sentiment plunged further in April 2025, fell by 29% since December 2024 due to the uncertainty around trade policy and the potential for a resurgence of inflation looming ahead. U.S. yields reacted to the sentiment by rising to 4.49% intra-month due to a number of factors, including increasing inflation fears, weak auctions, and foreign selling. Yields fell back to 4.16% towards the end of April 2024, mainly due to growth concerns. U.S. Manufacturing Purchasing Managers Index surprised on the upside with a modest growth of 50.7 in April 2025, which was far better than market expectation of 49.1. This was driven by domestic demand, though export orders declined significantly. Input costs rose at a sharp pace driven by tariffs, supply issues, and a weaker exchange rate. On the inflation front, while CPI and core CPI slowed to 2.4% and 2.8% respectively, lower than expectations and February 2025 prints, expectations of inflation have remained elevated. The Michigan one-year inflation expectations in April 2025 surged to 6.7% from 5.0% in March 2025, and the Michigan five-year inflation expectations in April 2025 hiked to 4.4% from 4.1% in March 2025. University of Michigan surveys consumers and presents the median expected price changes for the next 1 year and 5 years. The result of the 5-year inflation expectation remains the highest inflation expectation since July 1991. Japan. Yields in Japan fell sharply during the month as growth worries deepen. International Monetary Fund slashed Japan's real gross domestic product growth projection from 1.1% to 0.6% for 2025. As widely expected, Bank of Japan maintained its policy rate at 0.5%. It also sharply cut its growth forecasts, and Bank of Japan Governor Ueda said the timing for underlying inflation to converge towards the central bank's 2% target has been pushed back somewhat as trade tensions cloud the outlook. We understand interest rates may remain at the prevailing rate for this quarter before resuming its course for further rate hikes. The 10-year G-Sec traded in a band of 6.32% to 6.50% and closed at 6.36% in April 2025, vis-à-vis 6.58% in March 2025. Sovereign yield curve bulls steepened during the month, with short-term yields falling more than the longer-term yields. Systemic liquidity surplus, post the measures by RBI to infuse liquidity, such as open market operations and long-term Forex swap, rate cut by RBI and the expectations of further rate cuts on account of slowing growth and cooling inflation in India have pulled down G-Sec yields. At primary auctions, yields of 91-day T-bill, 182-day T-bill and 364-day T-bill softened sharply by approximately 62 basis points, approximately 59 basis points and approximately 55 basis points respectively due to the aforementioned reasons. Consumer Price Index (CPI) inflation remained below 4.0% level at 3.34% in March 2025 from 3.61% in February 2025. The reading also came in lower than the Bloomberg's median poll of 3.50%. During fiscal year 25, average CPI inflation stood at 4.63%, considerably lower than 5.36% in fiscal year 24. Food and beverages inflation moderated to 2.88% in March 2025, lowest since November 2021. Vegetables noted a deflation of 7.04% in March 2025 on a year-on-year basis, led by a sharp decline in prices of tomato, garlic, ginger, cauliflower, etc. Along with vegetables, pulses also noted a deflation of 2.73% in March 2025. Core inflation slightly increased to 4.1% in March 2025 from 3.99% in February 2025. Inflation has receded in the past few months, aided by a sharp decline in food prices. As inflation is expected to remain closer to the target of 4.0% in fiscal year 2026, it is likely that the RBI would continue with monetary policy easing. During the month, dollar index depreciated by 4.40% as growth concerns linger in the US. The evolving trade dynamics and a potential trade war can impact US growth adversely. Indian rupee INR portrayed continued strength in April 2025 and appreciated by 1.13%. INR traded in the range of rupees 84.50 to 86.70 per USD during the month, and ended the month at rupees 84.50 per USD, strongest since November 2024. In terms of the 40-currency real effective exchange rate, RER, INR continues to be overvalued, above 100, however has come significantly down from the recent high. Also, in March 2025, Indian rupees on a RER basis dropped to 101.5, lower than the 10-year average of 103.1. Foreign portfolio investments were net sellers in debt markets with an outflow of US $2.8 billion, while equity markets observed a marginal inflow of US $0.5 billion in April 2025. Forex reserves, after making a low in January 2025, have observed continued increase, partially owing to RBI's USD per INR buy-sell swap. During the month, till April 18, 2025, Forex reserves increased by US $20.7 billion and stood at US $686.1 billion. Liquidity conditions during April 2025 became considerably favorable, aided by RBI's open market operations purchases and increased spending by the government. RBI in April 2025, through open market operations purchases, infused liquidity to the tune of approximately 1.2 lakh crore rupees. Banking system noted a daily average surplus of rupees 1,39,759 crore in April 2025, compared to a daily average deficit of rupees 1,23,665 crore in March 2025. Going forward, liquidity conditions are expected to remain comfortable, aided by RBI's easy monetary policy and continued liquidity supportive measures. Global The probability of recession in the next 1 year in US has risen to 40% according to Bloomberg Economics. Amidst growth worries and waning policy confidence, dollar index has reached a 3-year low of 99.47. On the other hand, inflation remains above the Fed target, and tariffs pose further upside risks. Further, labor markets broadly continue to remain tight in US. Given the situation, Fed's policy response will be closely watched. Markets expect around 4 to 5 Fed rate cuts in calendar year 2025, with Fed expected to keep policy rates unchanged in May 2025. Concerns about inflation and fiscal policy may keep US yields elevated. Business sentiment and consumer confidence has been faltering, however. Its impact on growth may be seen with a lag by a few quarters. Further, a rare sell-off of US assets, both dollar index and US Treasury yield, was witnessed towards other safe haven assets. Example: gold. Gold touched an all-time high of US dollar 3,423.98 in April 2025, but closed lower at US dollar 3,288.71. China's continuing sluggish economy is expected to have support both from monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. However, developments related to US tariffs on China need to be monitored and its impact on the global economy. Japan, on the other hand, is on a rate hike journey, and the continuing unwinding of yen carry trades have affected yields adversely. Domestic. Given the growth focus by both the government, fiscal support through income tax cuts, and monetary policy committee, monetary support continued with another repo rate cut of 25 basis points. A dovish monetary policy committee policy meet in April 2025. A further rate cut of at least 50 basis points is widely expected in 2025. Further, Consumer Price Index moderated to 3.34%, aided by a decline in food prices. RBI has also shown consistent support to the economy through ample liquidity measures, resulting in systemic liquidity surplus in the month of April 2025. Such support from RBI is expected to continue as and when required. Factors that bode well for the domestic bond market include inflation being in line with the target, growth, which is resilient though moderating, and growing expectations of further rate cuts. Thus, we maintain a bullish bias on the sovereign yield curve and the corporate bond curve and expect the domestic yields to move lower. Further, while the corporate bond curve is currently slightly inverted, we expect it to normalize over time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.